In this video, I'm going to go through the notes for topic 5, the capital asset pricing model. In the last topic, on the single index model, we talked about a single index based on the macroeconomic risks associated with an individual stock. The capital asset pricing model is the foundation of that idea and is really the theory that's been developed over time, and one that's frequently used by investors, if not to actually determine the expected return, at least to determine the excess return we get, using the capital asset pricing model as a way to evaluate the amount of return that's necessary for the amount of market risk that a firm that an investment has. So just to go through the notes a little bit, the capital asset pricing model, and this is generally referred to as CAPM, was developed in the early 1960s by William Sharpe, John Littner, and Jan Mosen. It is an extension of the Markowitz portfolio selection model, and just as a reminder, with that model we calculated the optimal we calculated the optimal weights in a portfolio based on the variance-covariance matrix of different individual investments and the returns on those investments. But the key thing here is that we use the standard deviation of the individual firm's investments as the measure of risk. With the capital asset pricing model, the measure of risk is not the standard deviation, but rather the beta, the relationship the returns for an individual stock have with the macroeconomic risks. So it's an extension of the Markowitz portfolio selection model and assumes that all investors have identical expectations, but not necessarily identical risk aversion. And so all investors would have an identical portfolio of risky assets, P, and that portfolio is the market portfolio. The capital allocation line is then identical for all investors. So if you think back to a few lessons ago, I showed you the capital allocation line. Well, this line is going to be identical for all investors because they all have the same portfolio of risky assets, and that set of risky assets is the best set. It gives us the best risk-return relationship, and it's referred to as the capital market line. So that one capital allocation line that's true for all investors is referred to then as the capital market line. The market portfolio M is the portfolio of all investable assets with weights determined by all investors and is consistent with the Markowitz portfolio selection. So theoretically, the idea is that we take all of the investable assets in the world, not just stocks, not just bonds, not just options. This would include cars, this would include houses, this would include real estate, this would include my son's Pokemon cards. Anything that you can invest money in is included in this big bundle of all investable assets, and the weights that we would have of our wealth in those assets for the risky portfolio, the market portfolio here, would be the same. And so the determination of where we would be at, an individual would be at, for the complete portfolio would be between the market portfolio, the best portfolio of risky assets, and the risk-free rate and the risk-free asset. And that would depend on where we're at, depend on our level of risk aversion. Since the market portfolio is the optimal portfolio and the tangency portfolio on the efficient frontier, so if you think back to when I went through that graph and showed you where the efficient frontier is, all investors can take a passive strategy of investing in a mutual fund that holds the market portfolio, that one portfolio, and the riskless asset based on their level of risk aversion. If the CAPM is true, then the market portfolio is the optimal portfolio. This means that security analysis used to select stocks isn't useful and won't result in a superior portfolio. So I'm going to jump ahead here for just a minute or two. Recently, I was part of a retirement investment committee that analyzed different proposals from different companies that include, a portion of their company includes analyzing investments and choosing choosing the best ones as options for retirees. So if you think of a 401k plan, some of you may have a 401k plan. If you have a 401k plan, your employer, who the 401k is through, will usually provide you a list of possible investments. So you're not usually allowed to invest in individual stocks with your 401k, but they'll provide different mutual funds and index funds for you to invest in. Someone has to pick out what those funds are, what those options are. And the idea is that we don't want to give retail investors, your average investor, a lot of different options to invest in. So they want to pare down all the investment choices, all of those different funds you can invest into maybe 20 or 30 different funds. Okay? So they have to do a good job of selecting the funds. As I was going through the proposals for the different companies, we had about 13 different companies that we took a look at. A common theme arose. And again, these are just from the investment managers for these different companies. The common theme was that for a lot of different funds, the passive strategy was best. Okay? So again, this is kind of what I saw from these investment managers. That passive strategy works well for investment into large, well-known firms. And we're going to get into this idea later on when we talk about the assumptions of the CAPM. But with large, well-known firms, and so to kind of put this idea in your head, this would be Amazon, Apple, Microsoft, Ford, General Motors, General Electric. These are firms that most people are familiar with. There's a lot of public information about them, a lot of good information. I mean, the quality of the information is very good. It's fairly easy for people to get research and get information on these companies, and so they can get a very good idea of the future of the company, what the company's investing in, and just a solid picture of the individual firm. When you get out of these large, well-known firms, these investment managers fairly consistently said, if you're looking at small companies, if you're looking for companies in kind of different industries, so for example, if you're looking at companies that specialize in, natural gas drilling, for example, well, that is a very specialized industry. And so you need additional knowledge, an additional set of knowledge in order to effectively be able to choose companies in that industry. So if you're looking for funds, so we're going to talk about passive funds versus active funds, but if you're looking at funds within, that covers that industry, that's where you want to get into active investing. You want to find a manager who actively goes out and chooses stocks and chooses investments for that fund. So active strategy works well for investment in smaller, less known firms and in specialized industries. And so I'm going to come back to this idea later on, but I wanted to address it up front to give you an idea of what we're going to be talking about. So passive strategy is again, we have a rule that we follow for the S&P 500. Those are the largest 500 firms in terms of market capitalization in the U.S. So whatever those 500 firms are the ones that go into the S&P 500. There's not a manager, an investment manager that's sitting there and picking and saying this is a good firm and this is a good firm. They're just saying, hey, these are the largest 500. That's our index. Okay? So that's the idea of passive, is that there's not someone actively selecting stocks. They're just following a general strategy of putting stocks or other investments into a fund. Right, so we're going to come back to this idea later on in this topic area. The risk premium of the market portfolio. So the proportion of an investor's portfolio that is invested in the optimal risky portfolio is calculated as, and we've seen this before, we take the returns for the portfolio, and before we had that as R sub P. Now we're just as RM, because remember in the last set of notes we have the market portfolio, which is the best portfolio. We have it again here. So that's our best portfolio that everyone will want to put money into, and the proportion of their wealth that goes into that is based on their level of risk aversion. So Y is equal to the expected return for the market minus the risk-free rate divided by the level of risk aversion for that individual investor multiplied by the variance of the market portfolio, where A is the investor's level of risk aversion and sigma squared M is the variance of the market portfolio. E, the expected return for the market minus the risk-free rate, is the market risk premium, or E capital RM. The market risk premium is based on the average level of risk aversion in the market and is calculated as E capital RM is equal to the average level of risk aversion multiplied by the variance of the return for the market. So very early on in the notes that I've recorded for you, I talked about that we were going to do this. We were going to calculate the average level of risk aversion, that A number for the market. These returns are a little bit dated, but they're fairly consistent over time. The average excess return for the market for a period of about 10 years was 7.9%, and the standard deviation for the market for the S&P 500 return was 23.2%. So if I rearrange this and solve for A, I'm going to say the average level of risk aversion is equal to the expected return for the market, or the return premium for the market, divided by sigma square M. And this won't work if you just take an individual year, because in an individual year you can have a negative excess return, which would make this whole number negative, and you would say, oh, people are risk loving, which we know isn't the case based on what goes on in the market. So this was calculated over a long period of time. So if I calculate this, I get a value of 0.079 divided by, I'm going to take this 0.232 squared to get the variance, 0.0538. Okay. And that's going to give me an average level of risk aversion in the market of 0.079 divided by 0.0538, which is 1.47. So the larger the return is relative to the risk in the market, the larger the level of risk aversion is, which means that people require a higher return in order to be compensated for that risk. How do investors in general get higher returns? They get higher returns by not buying the stock at high prices, letting the prices go down. And a drop in stock prices is a normal reaction to a negative market event, because what people are saying then is that the return they expect at the current price is not high enough, and so there's a pressure, people are selling the stock, and there's a pressure of selling versus the pressure of demand for the stock, the buying of the stock. So as a result, stock prices drop, and so that increases the return in the future for the stock, because as you know, the company generates profits and cash flows, that stock price is going to go up. So the people in the market participants, determine what the return is for the market. They determine what the standard deviation of returns is, and that's based on the level of risk aversion. The level of risk aversion in the marketplace. So based on the time period that I looked at here, the level of risk aversion A was 1.47. And that's just a general way to calculate it. I might ask you on a test or in an assignment to go ahead and calculate the average level of risk aversion for investors given this type of information. So the security market line is the capital allocation line that is constructed using the market model, the market portfolio M as the optimal efficient portfolio P. So far we've talked about the security market line, the capital market line in the last set of notes, in this set of notes, and the capital allocation line. So the security market line, again, is the capital allocation line that is constructed using the market portfolio M as the optimal efficient portfolio P. So the equation for the security market line says that the expected return for an individual investment is equal to the risk-free rate plus the beta for that firm, so its sensitivity to market risk, multiplied by the expected return for the market minus the risk-free rate. So I want you to notice here is that these are not capitals, so this is just the return, not the excess return. This is the excess return for the market. The way not to calculate this is to take the historic return for the market and subtract out the risk-free rate. It's the expected return for the market. The reason why we don't want to take historic returns, at least in the short term, is that the return for the market can be negative. In 2018, the return on the S&P 500 and most classes of in risky assets were negative. So if we use negative returns to calculate this, that would actually give us a negative risk premium here. And this risk premium is forward-looking. So E capital RM is known as the market risk premium and is also known as the equity risk premium. And these are forward-looking. So forward-looking risk premiums. So what they measure is the additional return the average investor requires to invest in the stock with average market risk. So it's the return in excess of the risk-free rate. So the expected return on the market minus the risk-free rate. The size of the market risk premium or the equity risk premium is going to depend on the level of risk aversion in the marketplace. The more risk averse people are, the larger that number is going to be. Okay, the more they're going to require to invest in a risky asset. So right here I have again what I just stated, that market risk premium is a forward-looking risk premium for the market, and the beta is calculated from the market model, which is the excess returns for the individual stock. Remember, that is the return minus the risk-free rate is equal to an intercept that we're going to get from the regression plus the product of the beta that we get from the regression multiplied by the excess return on the market, plus for each time period we'll get an error term that's uncorrelated with the market returns. So using the security market line, we can theoretically estimate the return for a security using the beta of the security, the risk-free rate, and the market risk premium. So if the risk premium for the market is 5.5%, the risk-free rate is 2%, and the graph of the security market line, then the graph of the security market line would be as follows. The slope of the security market line is equal to the market risk premium. So if you think back to about 6th grade, you might remember the Slope-Intercept Form. And back then you might have asked yourself, when am I ever going to use this idea? When am I ever going to use Slope-Intercept Form in real life? And well, we might not quite be at real life yet, but you're going to use it now. The Slope-Intercept Form said y is equal to mx plus b, where m is the slope, x is the value on the x-axis, and b is the y-intercept. So, up here, we've got the equation for the security market line, which is in slope-intercept form, kind of. The risk-free rate is b is the y-intercept. The beta is the x value, and the market risk premium is m. Okay. And so for any value of x, the beta, given the market risk premium and the risk-free rate, we can calculate the expected return for an investment. And the idea behind the CAPM is that it's not just stocks, it's bonds, it's real estate, it's Pokemon cards, it's every type of thing you could invest in. You should be able to determine the required rate of return for that investment using the security market line. So the y-intercept of the SML is the risk-free rate. The x variable is the beta, and the beta is the capital Greek symbol for that. That is the capital symbol for beta in Greek. The slope of the line is equal to the market risk premium. And this is E capital R M is the market risk premium. All right, so based on the graph above, what is the expected return on the market portfolio? So we're going to take the expected return, our little rm is equal to the risk-free rate of 2%, 0.02 plus, so for the market, beta is equal to 1. It's going to be 1 multiplied by 0.055, which is the market risk premium for the market is 5.5%. So that's going to give us an answer of 7.5%, which is 0.075. All right. So again, the idea behind the CAPM is if I know the beta, so given this information for any firm, all I need to know is the beta, and I can give you the expected return for that company. So what is the expected return on a stock with a beta of 2? The expected return is equal to 0.02 plus 2 times 0.055. And so 2 times 0.055 is 0.11, 11%. Plus 2% would give us 13%, 0.13, or 13%. Okay. So again, if I know the risk-free rate and the market risk premium, and I believe that the CAPM is correct, then for any asset, if I get the beta, I can tell you what the expected return is for that individual asset. The excess return alpha for a security is the amount by which the return lies above or below the security market line at the beta of the security. If the expected return for a security is 10%, it has a beta of 1, the risk-free rate is 2%, and the market risk premium is 5.5%. What is the alpha for the security? So what is the excess return that the firm is getting? So alpha is equal to R sub I minus R sub F plus the beta for the firm multiplied by the market risk, the expected market risk premium. That looks right. Okay, so my return is going to be 10%, 0.10, minus the risk-free rate is 2%, 0.02, plus the beta is 1, multiplied by 0.055. So we've calculated this before, and this is 7.5%, so 0.10 minus 7.5% is 0.025. So we would expect the alpha in this case, the excess return, to be 2.5%, because in order to compensate us for the level of risk, we would only need a return of 7.5%. So the excess return is going to be the return we expect to receive that is in addition to the return that's required by the model. Okay. This is a very common number, and you're going to see this later on in a piece of research that I included here. This is a very common number for active money managers to use to evaluate their performance and the performance of other money managers. It's a risk. It accounts for the market risk of the portfolio of the investment that the active managers have chosen, and so it's a fairly common measure that you'll see. Since one of the assumptions of the CAPM is that all investors have identical expectations, the expectation of a positive alpha would be the same for all investors. So in other words, if we said, hey, this firm's doing really well, they're going to have excess positive returns. How would investors respond to the expectation of a positive alpha? So if you were fairly certain and you shared the same idea that a firm was going to perform really well relative to its level of risk, what would you do? Would you go out and buy the stock or the investment? Would you sell it right now, or would you not do anything? Most investors would see this opportunity and go out and buy the stock. Investors would likely go out and purchase the stock or the investment, whatever it is, okay? But I'll just say stock in this case. What would happen to the price of the security with an expected positive alpha? The price would increase, because now you have the demand for the stock would outpace its supply. More people are wanting to buy the stock than sell it, and so the price for that stock is going to go up. The price of the stock would increase. So what would happen to the alpha? The alpha would go away. The alpha would, as the price of the stock goes up, the alpha goes down because the expected return goes down because you're paying more for that asset. So the alpha would decrease to 0. And we see this happen all the time in the market. When you hear some big news about a company and then you watch its stock price, so let's say some really good news comes out about Apple. So engineers look at the new Apple design, and it's sent out to major news outlets and websites, and they're just fawning over it, saying it's the best thing ever. And everyone needs to buy one. Well, people will hear that and they'll go out and buy stock in Apple because they're like, wow, they're going to do really well with this new iPhone. Okay? And so what will happen is the price of the stock will be driven up because you've got that pressure from the buyers outpacing the sellers. And so the price goes up and that alpha then goes down. Okay? It goes down to 0. The opposite also occurs. Bad news comes out about the company, so you would actually have a negative alpha. And the people go out and they own the stock in the company and they want to sell. So the pressure from sellers is greater than the pressure from buyers. So there's more sellers than buyers out there. And so in order to sell their stock, investors have to continually lower the price that they're willing to sell at, and that's going to make the alpha go from a negative number to zero, because the stock price is going to go down. So suppose the investors believe that a security had a negative alpha. What would the market response be? In that case, the stock price would go down. Price would decrease. And alpha would fall, or actually in this case increase, to zero. So in an efficient market, in a completely transparent market where we all have the same expectations, the alphas should all have the alphas of every security should be equal to zero, because prices are moving to reflect changes in expectations for the firm. Let's move on to the assumptions of the capital asset pricing model. So like I said, this model was developed in the 1960s. The push for the model was to have a computationally easier way to calculate the weights of different assets in a portfolio. We do that with the Markowitz optimization. However, back in that time, you didn't have computers. You didn't really even have calculators. You had to do a lot of these calculations by hand. When we finally got computers, they couldn't do the level of calculation necessary very easily. You had to use a computer the size of a room. And so there was a push at that time to find an easier way to calculate the weights of different assets in a portfolio to get the best outcome. So some assumptions of the capital asset pricing model is that investors are rational mean variance optimizers. That's pretty a pretty acceptable assumption there. Nothing wrong with that. In general, at least in the long run, people tend to be rational. We tend to be mean variance optimizers. In other words, we're looking for the mean refers to the mean or average return. The variance refers to the risk of the investment, and so we want to find investments that give us the best risk-return relationship or risk-return trade-off. So yeah, that's a fairly good assumption. Their planning horizon is a single period. That might not be true, but if you think of someone retiring for investment, that would be a single period investment horizon. So let's say I'm expecting to retire in 22 years. So my investment horizon is 22 years. Okay? So I'm not trying to plan for multiple horizons. I have one horizon. The last is that investors have homogeneous expectations. So we have the same expectations. That one's not necessarily true. A lot of people have different expectations for different stocks. But we have to make this assumption in order for the CAPM to work. The deviations from these assumptions are complications to the CAPM, and which researchers come in and they say, okay, what happens if this isn't true? And we're going to talk in the next section, in the next topic, about some things, some complications and how we deal with them with the CAPM model. So that's in individual behavior. Market structure, these are a little bit more difficult. Market structure, an assumption is that all assets are publicly held and trade on public exchanges. That's not really true, and that's why the CAPM really is applied generally to stocks and maybe to other assets that are publicly traded. I worked with a researcher once who, and I didn't do the research, but I gave them some advice on it, who wanted to use the CAPM model for real estate purchases, and that's a little more difficult because real estate doesn't trade on a public exchange. The importance of the idea of the public exchange is that prices are transparent. I can look at any stock that's traded on the New York Stock Exchange or the NASDAQ or any of the large international exchanges. I can look and see their price right now. I can know what their price is right now. Okay, so prices are very transparent if the asset or the stock in this example is traded on a public exchange. Short positions are allowed. Short positions are allowed. That's not a strange assumption. That's true. The problem here is that investors can borrow and lend at a common risk-free rate. That's something we talked about before whenever we were looking at the slope of the capital allocation line. So this is not true. Investors can lend all the money they want at the risk-free rate. If you want to lend money at the risk-free rate, let me know. I'd like to borrow money at the risk-free rate. But investors cannot generally borrow at the risk-free rate. That's not true. All information is publicly available. That's not true, but it's becoming more true, especially for stocks. I'm going to come back to that idea here in a minute. There are no taxes. There are taxes. There are no transaction costs. There are transaction costs. However, transaction costs are actually going down because we're using more technology. It costs less to transact, to make transactions through the internet or through electronic exchanges than it does in person. So this is going down. Information is getting better. There are still taxes. So the idea behind these market structures assumptions is that the idea is to remove any barriers to transacting in the marketplace. I'm going to write that out here. The idea is to remove, and I'm going to use the term frictions. Idea is to remove any frictions in the marketplace. So anything that would inhibit people from buying or selling stock or any investment is removed in this. Okay, so taxes impact people's willing to trade stock, to buy and sell stock, especially at the end of the year, whenever they can, see the tax consequences of selling shares of stock. They might forego that for the next year, where they might have a advantage tax-wise. Transaction costs, if you have high transaction costs, that's going to limit the trading of the asset. For stocks on the New York Stock Exchange or the NASDAQ, the transaction costs are actually quite low. But if you think of other assets like a home, the common commission you're going to pay on a house is about 6%. So when you go to sell your house, you're generally going to pay a 6% commission, which is a large transaction cost. So that inhibits the sale of houses. Not having all the information inhibits trade. And let me just give you an example of this. If you go to buy a car, and if you don't know this, this is the value I'm giving you today. If you go to buy a car and you go to a car lot and you go up to the window of the car and it's got the price on it, okay? It's usually got a lot of information there and there's a price. Okay, do not pay that price. Before I got married, my fiance at the time, who's my wife now, came to my job one day. She was all excited. She had the day off work. She had taken her car into the shop to get the maintenance done on it, and it was a fairly new car. It was a Dodge Neon. It wasn't a Dodge Neon. It was it was a Mercury, but it was it was kind of like a Ford Escort. And if you may not know what that is, it's a small, inexpensive car. Okay? She took it to the car dealership to get maintenance work done on it. She saw a Dodge Neon there, and she said, "Oh, that's a cute car." She thought it was a cute car, and she said, I think I want that cute car, that Dodge Neon. And so she went and talked to the salesperson, said, she would like to buy that car. They didn't negotiate on price. She paid the sticker price for it. She came and saw me at work and showed me the car. And first of all, we were engaged. We hadn't talked about buying a new car, for her buying a new car. And she said, we're not married yet. You haven't put a ring on my finger, so you don't get to decide what, a marriage ring, a wedding ring on that finger. So you don't get to have a say in the car I buy. But I'm shocked because she didn't negotiate the price down. Okay? It is important for transactions to occur that people can trust prices. Okay? And so when you go to buy a car, you can't really trust the price on the sticker. That's this manufacturer's suggested retail price. And what happens as a result of not being able to trust that price is that it takes longer to negotiate the price for a car and buy that car. If you could trust the price on a car, that is the best price you're going to get it at. That's the true value of that car. The seller wouldn't be willing to sell it for less, and you wouldn't be willing to buy it for more. Then it would be very easy to buy and sell cars. Okay, but because of that, the information is not the same. We don't have the same expectations. The true price is not publicly available. Then that slows down transactions. So these assumptions for the market model, the idea is that we're getting rid of any frictions, and that includes the information being publicly available, and that people have the same, up here, homogeneous expectations. All right. So that's the general idea of these assumptions. What is a short position? A short position means that an investor will borrow the asset, the investment, and sell it to repurchase it later, hopefully at a lower price. With the expectation that they will repurchase it later at a lower price. So the way that it works with stocks is that if you want to short sell a stock, first of all, you have to get permission. A lot of times brokerage houses won't just let the average investor come in and short sell a stock because the losses are potentially infinite. The potential loss from a short position is the amount by which the stock price can go up. So what you do and you'd only do this if you expect the stock price to go down. So you'd go to a broker, and you'd say, I'd like to sell a stock short. So let's say I want to sell Apple stock short. I think bad news is coming out about Apple, and their stock price is going to fall. So let's say Apple stock is selling for $300 a share. I don't know what it is right now, but I'm just going to say that the stock price, so the stock price today, S sub O, is equal to $300. So I'm gonna borrow that share of stock from another investor, and they don't know that this is happening. The broker's doing it for me, and I'm going to sell that stock for $300. My goal then is for the stock price to fall. So at some time in the future, at time 1, let's say that stock price falls to $250. So what I do is I sold the stock at $300. I'm going to repurchase it back at $250, return it to that investor that doesn't know that I borrowed it, and I'm going to make a profit of $50. Okay? My profit from the strategy is the amount by which the stock fell. Now, if what happens is the stock price goes up, the investor wants to sell their stock, then I have to go out and repurchase the stock at a higher price, and in that case, I'm losing money. So this is a risky position often to take, because in general stock prices tend to increase over time, not decrease, and so I have to I have a good idea that the stock is going to fall, the price is going to fall in order to want to engage in this transaction. What can also happen is that you can get what's called a margin call, where let's say you short sell the stock, but the stock price starts going up. Well, the brokerage house doesn't want to be on the hook for repurchasing that stock whenever the investor wants to sell it, the original investor wants to sell it. And so they're going to require you to put money in to cover the difference between the stock price and what it's increased to. So should they need to go out and repurchase that stock, then you're already going to have that money there. At a certain at a certain point, if you aren't making up that difference, so let's say the stock price goes up to 350 and you're not putting in the extra money, so they can repurchase the stock at the higher price, they're going to go ahead and call your position, and they're going to make you at that point repurchase the stock at the higher price, and so you can lose money very easily that way. So that's how a short position works. Short positions are allowed. However, you cannot borrow the money, so oftentimes people will borrow money for their margin at the risk-free rate. Why are 2C, and I have here, why are 2C and 2D important? No transaction costs and no taxes. And the idea is that these are frictions in the market that inhibit trading. And as these fall, especially transaction costs have declined significantly over time. As these go down, the market becomes, and we'll use this term more in the future, the market becomes more efficient. Prices react more quickly and more accurately to new information whenever we get rid of frictions in the marketplace. So what are the problems with the assumptions of the CAPM? Well, I pointed out some of these. Investors don't have homogeneous expectations. Investors can't borrow at the risk-free rate. And then there are taxes. And transaction cost. Sorry, that's an R. Transaction cost. So what researchers do then is they go out and they look at these assumptions, and what they've done over time is to determine what effect what happens to this market model, to the capital asset pricing model, if these assumptions aren't true. So they might look at, how do investors act if they have different expectations? What happens with the outcomes from this model if people can't borrow at the risk-free rate? And we did a little exercise in a previous lesson where we said they couldn't borrow at the risk-free rate. And again, and if you remember, that changed the slope of the capital allocation line. What happens when we have taxes and transaction costs? What effect do taxes have on stock prices and the volume trades of stocks? So those are all things that researchers do. In general, you're going to see a lot of people use the CAPM to determine the required rates of return, and especially to determine the value of that alpha. What we found over time is that the CAPM, and this shouldn't be a big surprise, but you see this taught in a lot of basic business finance courses and corporate finance courses, and a lot of investment courses too. The CAPM generally doesn't work very well for individual stocks, but it does work well for portfolios of stocks, of well-diversified stocks. We've got one more page to cover in this topic, and then we're going to start to get into what are some improvements that we've made in time over this capital asset pricing model. So let's flip to the next page. The capital asset pricing model in the investment industry. Investment professionals consistently use the alpha from the security market line as a measure of their success. Like I said, I've been looking at different companies lately as part of a committee to manage retirement accounts and the investments that are offered through those retirement accounts. And this is, again, a consistent way that even today, so you'll see the research here is kind of old, but even today, people are using that alpha to determine whether a fund manager is doing a good job. So if you have an actively managed fund, we talked about passive funds before, and those are generally indexes. So actively managed funds are funds for which there's a manager or managers who go out and select the investments that are going to be put into this mutual fund. Okay. So these are referred to as actively managed mutual funds. The key thing that you should know about actively managed mutual funds, other than how they operate, is that there are higher fees. Investors pay higher fees to invest in the actively managed fund than they do to invest in a passive index fund. For actively managed funds, than for passively managed. And so when I use the term funds in this case, I'm not talking like dollars. These are mutual funds. They're a collection of assets, and the way that they are created is either actively managed. So you do have that manager or managers that go out and select assets to be put into the fund, or passively, and I described that earlier as essentially we set up rules, and any investment that fits that set of rules is in the fund. So the example again being the S&P 500. Those are the 500 largest firms in terms of market capitalization for firms in the U.S. So any firm that is in that top 500 would be in the S&P 500. The reason we pay higher fees for actively managed funds is that those managers want to get compensated. They want to get paid for their expertise. They have to go out and they have to do research. Oftentimes these active managers will go out and they'll go out and they'll visit businesses, they'll visit locations, they'll visit the companies that they're looking at. I had an opportunity several years ago to work with a group of students who did a competition called the CFA Global Investment Research Challenge, and we acted as kind of like an active mutual fund manager would. We actually would go out and talk to the CEO and the CFO and the top executives of publicly traded firms to get an idea and essentially have them pitch the company to us why we should recommend an investment in that company. So there's usually a cost involved to the fund manager of an actively managed fund to go out and get that information, and again, their own time being compensated to do that. So they typically have higher fees than passively managed funds, where that research just doesn't have to be done. So this was an important piece of research here by Burton Malkiel, and he has actually a famous quote about how blindfolded monkeys throwing darts at a sheet of investments could outperform active managers. But a study by Burton Malkiel completed in 1995 shows that even mutual fund managers have a difficult time beating the market. So he found that the average alpha of actively traded mutual funds was negative 0.06. So in other words, that means that the alpha, the excess returns for an actively traded mutual funds, and these were many funds that he looked at for a period of 19 years, they didn't outperform the stock market, the S&P 500. And you can see here, this was the probability distribution of the alphas from all of these actively managed funds. It's kind of bell-shaped. It's got a long tail on the left-hand side. Some other information that came out of this piece of research was that the funds that outperformed, so the funds up here that outperformed the market, weren't consistent year to year. And recent research also shows this as well. So outperforming funds weren't consistent year to year. So it wasn't the same funds that were outperforming. So a selection of funds would outperform every year, and then would be a new set of funds the next year. And it was rare for a company, for a fund, to outperform consistently over time. So that's where we're going to end this topic. I do want to show you one thing online that has to do with that alpha. So I'm going to pull that up right now. There's a popular website that a lot of investors look at, and it's called Seeking Alpha. So I'm going to pull that up here. And I just wanted to pull this up because to explain the name. So alpha, again, is an excess return that is more than what is required for an investment to compensate investors for the level of market risk for that firm. And so the idea behind the website Seeking Alpha is that the people that post on here, the people who are reading the information here, are trying to find those good stocks. They're trying to pick stocks and do well as a result that are going to outperform the market. Anyway, it's a website you might want to check out. A lot of different people contribute to this site, and some get more coverage than others because they tend to have good ideas. Anyway, that's it for this topic. And please let me know if you have any questions over the material that I've covered. Please send me an email, and I'm happy to discuss any of these topics with you. Thanks.